So with that, we are going to talk about the Zeitgeist. Everywhere we go, we have a Zeitgeist panel. And I know that Jack Wyant could not join. Start standing. Start standing for a second. Start for a moment standing. And then, yes, and Greg. So we just passed the big, beautiful law.
I'm not stuttering. It's OBBBA.
Yeah. So Annex Anderson, tax partner, has really studied this. I hate that you're in front of the light, but we're going to start macro, and then you're going to chime in, and then we're going to have a global discussion. What the hell is happening in the world? How should we be thinking about it as we go next? So, Stephen.
Thanks, Mark. So I'm going to take a step back from where interest rates are going right now and all that to talk about 4 big issues that I think are things we have to keep in mind for how the world's going to act moving forward. And at ARS, we start our investment process by thinking about where capital is going to flow. What are the secular themes that are going to drive capital over the next several years, and who's going to benefit from it, and where's it going to flow away from? And if you get there first, you let the rest of the market bring you along, get your returns. So when we think about the world, we think about it, we invest in the US, but we think about the impact of the world because we've gotten so global. But when I step back and think about 4 big things that are weighing on the global system today, and on the US system in particular, I think the first is a mistrust of the institutions that have been governing us during the post-World War II period. And it's not only a mistrust of the institutions, but now, over the last several years in the US in particular, we've had a growing mistrust of each other. And it's really hard to move forward as a society if you have this excessive mistrust, because then you're constantly fighting with each other. And even on our calls the last couple of weeks where we have the pessimists and the optimists, I think a lot of that is driven by politics, not by the economics of it. And we're getting caught up in this sense of, in the zeitgeist right now of this mistrust that's going on out there. I think so I think this is a big issue, and it's playing out not just in the US, but you saw it in the Japanese elections today. You also are seeing it in what's going on in Germany with their elections. There's this divisiveness that's going on that we have to work through, because it gets very difficult to move systems forward when you're constantly swinging the pendulum of policy back and forth, and you end up working against each other. So that's number one. Number 2 is we're dealing with a world that has the highest debt levels we've ever seen, and they're getting worse by the day. And governments have limited fiscal space, and the population's demands are even greater than they've been at any point in time. Right? So we're seeing these challenges of what's going on in the environment, what's going on with education, what's going on with housing, what's going on with the job market for young people. These are all issues that are challenging the governments at a time that they've not taken advantage of the zero interest rates we had for 15 years to make the long-term investments. They keep dealing with the short-termism that's out there. Which leads me to the third area, which is the Fed and the Fed's independence, and is that important or is it not? And I will tell you, I believe that it's one of the most important issues facing the global economy today. And that's because what happens with the Fed will drive rates around the world, and it'll have a significant impact. And we saw that every time the Fed makes a rate move, other people react. The Fed doesn't really react much to other countries' policy setting, but other countries' policy setting certainly reacts to the US. And that's a really dicey area, because I believe the policies that are being put forth from the president to move rates down to 1% would be among the worst policy mistakes in economic history. And I don't mean that as even a slight underestimation of it. This is the worst policy we would ever have in history if we moved to rates that fast right now, because of what it would do to inflationary pressures. If you don't believe that, look back to last September when we cut 50 basis points and rates skyrocketed. Last week, when there was questions of the Fed intraday about the Fed's independence, the market dropped, bond yields spiked. So if you think that Fed change is going to be important right now and going to be a positive, I would not count on that to drive your investments going forward. One last thing on rates. The question that investors should be asking today, and it's an important one, are the rates of the last 15 years the rates you should be considering for investing going forward? Or are they an anomaly, and that the rates prior to that are really their levels? And we're at a level today that is the appropriate level for interest rates or nearer to the appropriate level, and that the zero interest rate environment that we all benefited from greatly over the last decade, it should be done. Because if we keep that up, the debt problem is going to get worse, our inability to cover the debts is going to get worse, and it's coming at a time that we are seeing challenges to growth that we're going to need innovation to drive us forward. And then the last thing I'll touch on gets to where I think the source of all these problems lies, in that where have all the statesmen gone? Look around the world. Who do you look to say that's somebody we should emulate as a politician? And it's really hard to find today a global leader that you could say that's the one that we should get behind. We're seeing that in the US today, and some people think the president's the one, some people think he's not. I think either party has been leading us to the wrong outcomes, so I'm not a fan of either. So my politics fit with Mark's goal is I'm neutral because I don't like either one of them. And I think they're both doing us a huge disservice. And if we don't get back to a more collaborative approach to policy, we don't have the fiscal support to get there. Yep. I was finishing, Mark.
Anyway, thank you. Always interesting. Is this on? Okay. It doesn't sound like it's on. Okay, I'll speak up. You know, it was interesting, one of the things that Steve said about the effect of politics. Whatever your politics are, it really is having an impact on investors today. And I think one of the easiest or clearest examples, when you look at the University of Michigan consumer sentiment surveys, which has gotten a lot of play the last few months because it was so negative after the imposition, or quote, the announcement of possible imposition of extreme tariffs back, thank you, in early April. And there was a huge division. That sounds a little better. Okay, great. So there was a big difference between Democrats and Republicans, you know, in that. I mean, the Democrats, it was almost below 40% were optimistic about the economy, whereas Republicans saw it at 85%. And interestingly enough, when you looked under the Biden administration, University of Michigan, it was exactly reversed. So it does have an impact, your views on how good a job whoever the current president or party is. You know, and so right now, one of the things Steve's giving a very pessimistic view of things that could happen, and it's all been there. And I think you saw the reaction in the market when the tariffs were announced, because if they had been kept in, I think there's not an economist out there that would disagree. It was going to be a disaster for the economy and for inflation. And as it is, estimates for GDP have come down. They were at about 2.5% at the beginning of the year. They're now somewhere in the 1 to 1.5%. Inflation, which had been coming down for a few months, sort of has tweaked up a little bit. You know, most economists look at it, you know, depending when the tariff impact flows through, could be up as much as a percentage point. But there is a lot of disagreement about whether it would be a one-time price hike. You know, and of course there continues to be uncertainty about tariffs. You've seen this in the last few weeks where the president has come out and announced, you know, oh, the EU, we're going to do 30%, copper, 50%, pharma. I mean, so it's been, but the market had a brief reaction on some of that. But I think it's been the attitude now, it's a lot of crying wolf and not serious about the draconian because he's been talked off of that. But we will see. There still could be a lot of surprises ahead. But right now, we haven't seen a lot of flow through in tariffs. There's been a little bit showed up in the PPI. We were starting to see a little bit less interest in travel based among lower income. And we've been seeing pressure on the lower income consumer for some time, but that seems to be showing up even more. But then when you look at the numbers, you know, we still have full employment. In fact, the employment number ticked down to 4.1% the last time. Retail sales just came up, but they were surprised on the upside. You know, we just had the major banks reporting. They say the consumer is fine. American Express reported this week, consumer is fine. And you had two of the biggest airlines, you know, United and Delta, say things are looking good, it's rebounding. So the consumer is still spending. There's been a lot, you know, of savings, and we'll have to see how much, you know, flow through. There's been a lot of inventory pull forward, and we don't know because of the uncertainty. Companies have not been able to decide where do we get this cost absorbed. Right now, they're pushing. It seems to be they're pushing back on the suppliers, taking a little bit of margin hit, which we will see as earnings start. You know, they did start 2 weeks ago with the banks. We'll see what happens, but it looks like for this second quarter, in April, a lot of companies withdrew their guidance or cut their guidance, you know, based on what seemed to be fact then. You know, how do you project out? So right now, after a first quarter earnings of 13.6% on average, You're coming into this quarter at 4.8%. So I think there's going to be a lot of room for upside surprises here. So this should be a decent quarter. And certainly, you all know the market's been making new highs. It's at a 22.5 PE. And so the question is, it'd be normal to have a pause here, but right now, looking at the economy, investors are looking through into next year where it looks like there could be an earnings acceleration. And certainly the Fed in recent meetings has said maybe 2 interest rate cuts this year. Hard to see, but we'll see what happens there. And certainly their predictions for inflation next year and lower interest rates are very much there. So this is what's happening right now in the market. They are looking through. Where we go in the short term, I don't know, because of the high valuation. But this earnings season is something to pay attention to, and I think we do have room for a lot of upside surprises. So with that.
So fun fact about Barbara, other than you'll see her at CNBC a lot, is that she is our pickleball 361. And she was All-American 2 sports back in her day. Let's keep it going.
Last century.
I'll try to keep it pretty macro because it's pretty hard for a tax attorney to get macro. But let me just give you a little bit of pause here and tell you what I'm seeing. I'm the only one here, I think, at least on the panel, that is not asking you for money for raises like MJ and Rafiq and Charles and others. But I'm also not investing money like a lot of you single-family offices are. I'm not managing money like Stephen and Barbara. I'm here to help you keep your money, okay? And one thing I haven't heard talked about today is after tax returns. Everybody talks, and we're talking all week about, maximizing returns. But let me just tell you globally, I think what's going on a little bit, what I'm starting to see. I have a law firm and a tax law firm and a CPA firm, and I've been doing this for 42 years. I'm glad there was somebody older than me here earlier this morning. I thought I'd be the oldest. But what I saw 20 years ago, maybe even 15 years ago, 75% of the business owners I met with, and I've done everything from sell sports teams, exotic car collections, everything. Everybody was always worried about taxes, right? Everybody has to pay them. You've got a silent partner in the form of the federal government, as we like to say, and even if you have no taxable estate, and your kids have no taxable estate, and your grandchildren have no taxable estate, you got a minimum 20% income tax silent partner, and people forget about that. We're still looking at 50% rates if you live in the wrong states, like you folks in New York and California, right? Move to Texas or Florida. Anyway, what we're seeing now is a huge shift because 75% of those clients I met with 15, 20 years ago almost universally wanted to try to pass the business down to the family. 25% knew that you're seeing the things you're seeing now in spades, which are, and I'm seeing a switch in that. 75% of the people I'm meeting with now, either as a result of the planning we get into or already know they're not going to pass it down to their family. The kids don't want to do what dad and mom did. They're not capable of doing it. They don't want to work as hard. All of the above. They want to do something different. They're shedding their advisors too. We're seeing that. And we have a multifamily office too. Get dozens of reports a week about what the family offices are saying. And it's become a dynamic where everybody's looking at exits, whether you're in something for a 3 to 5 year venture fund, we hope there's a 10-year exit. Everybody in this room is doing a lot of that type of investing, or whether you're looking to pass on the family business that's been around for 20, 50, or 100 years. So I think we're seeing a lot more focus on what I call exit planning. I think it was Ian asked me at break if I meant exiting the earth. No, I don't mean that. I mean exiting your business. I do a lot of estate planning, but I like to say I like my clients alive so we can do it while they're still alive. I don't do a lot of probate or estate planning after death. But seriously, I think what happened with the One Big Beautiful Bill Act, OBA, we're calling it OBA, it passed 16 days ago. This is the third time I think I've given this speech. So does anybody know what the vote was in the Senate that passed this thing on July the 3rd? It was actually 50 to 49, which is really interesting. You'd think, why wouldn't it have been 51 to 50? 2 of the senators didn't vote. They weren't there. But they needed J.D. Vance to break the tie. To Stephen's point about us being divided, I don't think there's anything, with the Republican administration in both houses, nobody thought that we were going to have the problems we had getting this passed. This thing went back and forth like a tennis ball for a year and a half because we had totally different platforms under the Democratic and Republican regime. I think some of the things that didn't pass are as important as anything else, like keeping the corporate rate at 21% with almost no discussion about changing that. Some people wanted it raised to 25%, even in the Republican administration. You didn't see any changes in the world I live in estate taxes other than making the exemption permanent. Anytime I use the word permanent, that's only as permanent as the next Congress that comes in 2 years. Seriously. Permanent means now we know next year we're going to have $15 million exemptions per person. That's our gunpowder that we've used for 40 years in planning, and it's the biggest and best time to ever do this in my career. They didn't change that, and they were trying to attack dozens of techniques that we've been using for 30 and 40 years. They totally hands off on that. That's the good news, the really good news. And it's also doesn't kick in until next year. There's a totally different effective dates for almost every provision. You really need to work with your tax advisor. That one, for example, doesn't kick in until next year, but then it's indexed for inflation every year thereafter. So I won't get into the nitty-gritties now. We'll probably get into that a little bit later. But I am seeing a huge shift and a huge divide. One of the themes, if I don't say it, I'll say it now so I don't forget, huge incentives to do and bring back domestic U.S. manufacturing. I think anybody that owns a portfolio company that does any kind of manufacturing of a facility ought to be aware of these changes in the depreciation rules. They brought back full bonus depreciation, but it only goes up to a certain amount. If you spend more than $4 million a year, it phases out. But for the first time in history, they allow an immediate 100% expensing, even for the hard construction costs of a U.S. manufacturing facility. I'm talking about the building and everything. I think that's going to stimulate a lot of investment in the U.S. A lot of the changes, they got rid of all the energy credits for the most part. Things where you used to be able to sell those if you were a big corporation, now you can't sell them to foreigners. There's a lot of things in this bill that's really intended, as Trump said from day one, to try to stimulate U.S. Economy. So I think you're going to see a lot more incentives and investments in the U.S. So that's one thing. And I don't know where you want to go from here.
What we want to do is open it up for questions. Questions, thank you.
How are the tariffs going to impact transfer pricing and where companies have been very much invested in certain countries around the world?
The answer is we don't know. And the other answer is I'm not an international tax expert. I deal mostly with U.S. Transfer pricing, which he's talking about, is how you price and sell your goods cross-border. I've seen a lot of influence right now with foreign manufacturing where people are extremely concerned about that with the tariffs. But, I mean, Stephen would probably know better than I, but Trump's been playing ping pong with this for 3 months. I mean, it's here today, gone tomorrow, 50% today, 20% tomorrow. Nobody knows is the reality. That's going to definitely increase the cost. And I think I was just speaking at an AM and AA conference, which is 75% private equity and investment bankers, and the theme was we just don't know how this is affecting M&A transactions, for example, because we don't know how to price it in. And if you're doing anything overseas in terms of your supply chain, it's a big issue right now. If you're a service business, it probably isn't. It really depends on what industry you're in, what countries you're in, where your manufacturing is.
Keep it going. Go ahead, Park. You talk loudly.
Yeah.
Hold on.
Sorry. Question kind of for whoever would like to answer, and I'd also like to get, it'd also be good to hear Stephen's perspective on it. I agree completely with, rates going down to 1% being, a catastrophic kind of situation. How realistically, how do you deal with the national debt, right? And one argument for lowering rates, right, is the interest expense on our debt. Practically, if you're thinking ahead 5, 10, 20 years, how do we deal with this problem, and how does that factor into the way you think about interest rates?
I think there's a mic up there. That's not a great question.
No.
I think the issue, we saw this in 2008, right? The reason we went to zero interest rates is you try and grow your assets to offset, to defease your debt. And we tried that once. And we could have gotten there if we didn't then pile on all the other stuff we did after we took care of the great financial crisis for the pandemic. So we actually have to get back to a level of fiscal discipline that is reasonable. And the only way you do that really is to cut spending and raise taxes and grow your economy better.
Barbara just stood
Not
up.
that hard. I mean, AI, though, and productivity are the two of the big answers for it. And I think that's what Barb's going to come with.
Yes, no, productivity is a big one, but I did want to point out, that when the Fed did cut, and you mentioned this earlier, the 50 bips in September last year, the long end went up, and so the Fed could cut rates to 1%, but that's the short end, that's the 2-year, and it's really the 10-year and beyond that controls, the deficit, and there's been a lot with this tax bill that just went through. They say it will bring the deficit down, but every independent analysis says the deficit's continuing up, so we're not showing any real fiscal discipline, and certainly you've seen in abroad, there's no stampeding away. We've got the deepest, markets in the world, we're still the world's reserve currency, but in the last 25 years, you've seen a reduction in the dollar holdings and foreign reserves from, I think it's something like 68% to 50 something. And you're certainly seeing why gold is now, I think, is actually in structural demand change, because especially since Russia's 300 billion in foreign reserves were impounded or frozen in 22, other central banks went, oh my God, that could be us. And you have, I think, India and Russia, their gold reserves are like 6 and 10% versus our and Germany's are at 75, 76%. So you are seeing on the margin, people are trying to figure out a way not to be as dependent on us. And that, we've got huge supply, we've got to finance, and that's very different than what's going to happen in the short end. So, yes.
You just said something brilliant, which I think is severely understated. The fear of central banks to hold U.S. dollars. How does this U.S. Treasury, or frankly the Fed, counter that? Because that is a massive foreign policy implication of the sanctions that we have on Russia.
Yeah, it's a huge issue, and you may have something to say about that, but the Fed doesn't control that. The Fed's, mission is really employment and inflation, and that is not their mission. Like right now, the president is trying, you've got to lower it so it lowers our interest rates. That's not part of their mandate. It's formal and legal what they're supposed to be doing. And that's not going to change. It's what they do on the short end. So I don't know if, Steve, you have any comments?
Greg's got a quick comment.
Yeah, believe it or not, there is a tax angle to interest rates themselves. One of the changes in the bill back in 2017, one of the revenue raisers they put in, everybody thinks it's all about tax cuts, but it's not. And that's the ugliness of politics. There's so many revenue raisers. They put in limitations on deductibility of interest expense for businesses. And it was generally defined as 30% of your EBITDA, earnings before interest, taxes, and depreciation and amortization. One of the changes in the bill was they raised that to 35%, and now it's just EBIT without depreciation and amortization. So they actually increased the amount you can deduct, but if you go back and look, what were the rates in 2017 compared to today? It's really not a increase in the deductibility. It's actually a smaller percentage. I don't think anybody's focused on that yet. So interest rates do play a part in tax politics too.
And I would just say on the people pulling their money out, it's actually been China primarily, and they're down from like 1.2 trillion to 750. They've been aggressive. Japan's been somewhat aggressive, but other people are adding to the U.S. Treasury holdings. And there's also a thought that possibly stable coins could actually ramp up the holdings of treasuries as well. I'm not an expert in this area in stable issues, so I don't know, but I think that issue is overblown to two countries who have really big holdings, and that's China and Japan. And I think China has been passed by the UK as the number 2 holder of treasuries now. So. Yep. Oh, that's the other thing is bank deregulation. Barb just added is going to allow them to hold more treasuries on the balance sheet.
Just 1 second. I like new voices.
Thanks. Hey, Stephen, this is kind of a follow-up to your original comment or your earlier comment about the lack of trust in institutions. One thing you didn't talk about, right, is there's an X and a Y axis to this. I know you probably read Strauss and Howe, Fourth Turning, right, kind of, and then the Fourth Turning is I'm sorry. The Fourth Turning is written by a couple of American political scientists about how the United States goes through existential crisis about every 80 years with a predictable periodicity, Revolutionary War, Constitution, central bank, no central bank, right? Civil War, Depression, World War II, and here we are, 2020. There's a trigger event. It's the GFC, it's COVID, all the things that we talked about. But in the middle of all this, right, the generations in power, and then the massive distrust between boomers and millennials is, how do you fix that? Because if you don't fix that, and the millennials and the generations subsequent to them feel like they have no ownership, they have no stake, they have nothing to gain, then this comes down to nationalism versus communism in almost every country, right? In terms of where, the worst case scenarios play out. Not to go too far down the road, but I mean, that's. You went pretty far. I did. I mean, I'm not to like bump them, just to bump up against the next panel.
I think that might be a.
So how do you deal with that? Because if people believe that their vote doesn't matter, right, whether you're right or left.
All right, we got to move to the next panel, but someone want to take those theories?
I would just say we have done a huge disservice to our kids. We wrote a newsletter a couple of years ago called "Sending the Bill to the Kids Table." So we're not only screwing them on jobs and the environment and everything else, but we're also leaving them with massive debt and no houses. I think we have to change our educational system and change our educational emphasis for one. I think we have to rethink how taxes cover education in the U.S., so that would be one thing. I also think we have to rethink what jobs add value to the world and how they're compensated and how they're not. And teachers don't get paid anything, police and fire don't get paid anything, risk their lives every day, and you go to Wall Street and make a lot of money. So there has to be a balance there. I don't think there should be I don't agree with the potential mayor candidate that there should be no billionaires, but I think there has to be a different system that makes it a little bit fairer. But I think it starts with education and getting that right and getting what jobs matter right too. We've gotten people away from crafts, from trades, and we got rid of those in schools. We cut them out of school budgets when we should have been increasing them because it's a path to $1 million a year.
God love him. God, yeah. First of all, whatever makes your kids happy, that's crucial. We shouldn't have to be so hung up on starting Facebook. But we have to move on to another panel because I'm not doing a good job regularly. I'm sorry. We're going to
respond to what he said.
Nope. Sorry. Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.